What's good, YouTube? What's good, man? Let's get into it. I ain't gonna hold y'all up. We're gonna get straight to it. Y'all see, I got the board behind me. It's time to learn, man. It's time to learn. Today, we're talking about PE ratio, price to earnings ratio. Let's get straight into it. I'm gonna pull up something that's important. Netflix, they did earnings today. They're going crazy. Look at that after hours, 996.59, man, up almost 15% after hours, up $125.91. But that's not what we're here to talk about. We're here to talk about price to earnings ratio. What is price to earnings ratio? Man, that's crazy. Price to earnings ratio is a key financial metric used to value companies by comparing a company's stock price to its earnings per share. Now, if you don't know what earnings per share is, I did a video about that. I'll link it at the end of this video so you can check it out and see what earnings per share is. But simply put, earnings per share is a metric that you can use to see how profitable a company is or see their corporate value. So when we're looking at Netflix, we're here on Yahoo Finance. When we're looking at Netflix, you see they have a earnings per share of $17.68. That means that for every one share of Netflix, the company is earning $17.68 of profit. Now, if you want to know more in depth, go type into that video. We're here to talk about PE ratio right now. You feel me? PE ratio. So, PE ratio for Netflix, 49.19. 49.19. How do you find PE ratio? What's the formula? This is the formula. PE ratio, you take the price per share and you divide it by earnings per share or EPS, and that gives you price to earnings ratio. You feel me? So let's go back here. Now, if you take this 869.98, if you take this 869.98 and you divide that by the earnings per share right here, this trailing 12-month earnings per share of 1768, you're going to get 49.19. Now you may say, how do I know my math is right? How do I know my math is right? You can take this PE ratio of 49.19 and you can multiply it by your earnings per share of 1768 and you will get 869.68. You feel me? Now, what can we use PE ratio for? What does PE ratio tell us? PE ratio, we can use it to tell us a couple of different things. One thing I want to say before we even get into that, PE ratio, you do not want to use it as a standalone. You don't just look at PE ratio and say, okay, I'm going to buy, or okay, I'm not going to buy. You need to be using these metrics along with other metrics, along with fundamentals, financials, guidance. You need to have these things in your toolbox so that you can know how to utilize them. But these can be quick, fast indicators that you can use to see a stock and kind of know what you're looking at. Another thing, when you're using price to earnings ratio, this is a good comparison tool that you can use to compare, say, a Netflix to another company that's in the same sector. So you wouldn't be comparing the PE ratio of Netflix to the PE ratio of an Nvidia. You're going to want to compare a PE ratio of a Netflix to maybe, say, a Disney. You see what I'm saying? And you can take those two PE ratios to see. You can get the PE ratio of a couple of different stocks within that sector and kind of see what the average is. You'll be able to see kind of what's on the higher end, what's on the lower end. So if you're comparing Netflix, see what their PE ratio is, which is 49.19, to it maybe a Disney's. What's Disney's? I think last time I seen it was 39.96. Okay, so yeah. So Disney's PE ratio, 39.96. It's lower. It's lower than Netflix. So that would mean another thing, sometimes you may hear PE ratio referred to as a multiple. What do they mean by a multiple? Well, this PE ratio means that if you're willing to pay $108 for Disney stock, that means that you're willing to pay 39.96 times the earnings per share for Disney stock. So when you're talking about price to earnings ratio, it can let you know, how expensive is this stock? Am I overpaying for this stock? Is this stock overvalued, undervalued? Does this stock have high growth expectations? Does it not? These are the type of things when you're looking at PE ratio along with other metrics that you'll be able to kind of discern when you're looking at PE ratio. So if we go back to Netflix, so you may say, well, I won't get into that. I'll show you an example. But you can see the PE ratio. See the PE ratio 49.19. We just seen Disney's. You may say, why is Netflix's PE ratio higher than Disney's? You know, do I want to pay, 49.19 times the earnings per share of 1768 for this stock? Am I paying too much? Is Disney the better deal? Well, that's why you watch the earnings per share video, so you can use PE ratio along with EPS to know that the EPS for Disney was like $2 and some change. This EPS is 1768. So you're getting access by buying this to a lot more revenue by going with Disney, even with that higher share price. And this PE ratio could be higher because Netflix has a lot of growth potential. Analysts expect a lot from Netflix in the near future. So that might be why they have a higher PE ratio. So you want to be paying attention to different things and looking into guidance, looking at their news, looking into the financials of the company, so you can see, why do they have a high PE ratio? You go and look, they may have good guidance, great things coming up. Okay, that explains why they have a higher PE ratio because, this company has great things on the horizon. They have a lot of growth potential. They have higher expectations because they have this and this coming out. They have this rolling out. They have this rolling out. Or you may look at a company and see a low PE, and you may think, oh man, it's a bargain. But back up. Go and see why they have a low PE. You might see that company has been underperforming the last couple of quarters. You may go and see that, that company has been, losing money. That company has been stagnant for the last couple of quarters. So that would explain why they have a low PE. A low PE doesn't always mean bargain, and a high PE doesn't always mean overpriced. You see what I'm saying? So you got to use. That's why I say don't use PE ratio. It's just a standalone end all be all. Use it along with other metrics. Now let's go to the board. Let's go to the board. Company A, company B. Now SP is share price. Share price $50. Share price, company B, $50. Your EPS, remember, which is your earnings per share. Let's say that is 10. Earnings per share. Let's say this is 25. And then what is your PE? What is your PE? Now, you should know. Y'all see the formula. Y'all see the formula up there. Y'all see the formula. Excuse my handwriting. Y'all see the formula. Company A, company B, they both have the exact same share price. They both have the exact same share price. What's the difference? Earnings per share is the difference. So that means with company A, you know, you're getting access to $10 of revenue or profits per every share. With this company, you're getting access to $25 per every share. Also, when you do the formula, which would be 50 divided by 10, what gives you a PE of 5. With a PE of 5. 50 divided by 25, share price divided by earnings per share gives us a PE ratio of 2. Now we got our PEs of 5 and a PE of 2. Put it down here so they know. PE down here equal 5. PE over here equal 2. Now when you're looking at this, You might say, okay, right now we're trying to decide which one is the better deal. We're trying to decide which one is the better deal. We're assuming that company A and company B are two stocks in the same sector. They both have the same share price of $50. Now we need to be able to discern which one is the better deal. Okay, so let's look at earnings per share. Company A is showing us that they're getting $10 of profits per every share. Company B is getting $25 of profit per every share. So we already know off top, company B, we're going to be getting access to more profits per share with company B. Now let's look at the PE ratio. The PE ratio, remember we said, is a metric that can let us know, how much are we paying for this? Are we paying too much? Are we paying too little? Is this a bargain? Is this a good deal? In this case, we got two stocks that are the same price. We're getting access to more profits over here with this earnings per share of 25. You see what I'm saying? And this PE ratio is cheaper. So we're getting this stock for 2 times its EPS, a two times multiple, 5 times multiple over here. So we're paying less for company B and we're getting access to more profits. Company B is the better deal. Company B is the better deal. You follow me? Y'all follow me? Y'all following your boy? All right. So, with that being said, man, that is PE ratio. Simply explained. We don't need to get all crazy with the jargon, crazy in depth, trying to confuse things and make it super technical. If you have any questions, hop in the comments, man. Hop in the comments. Like I said before, I'm still new to the whole teaching thing, man. I'm trying to get into the groove, man. Get into the groove. Let me know if you have any tips for me. Let me know if this video gave you any value. If it did, please like, share, and subscribe. And I'll see you on the next one, man.